In a fascinating turn of events, the perception of cash has undergone a major transformation. Cash was seen as trash, but it is now attractive according to legendary investor Ray Dalio. In his recent interview, he talked about how things are changing in the stock market and the way money works in the whole economy. So in this video, we will look at what exactly Ray Dalio is seeing and why the stock market and the economy are changing so much, and look at some tips to help you take advantage of these changes and not miss out on good opportunities. Ray Dalio is a billionaire and one of the most highly respected investors in the world. He's been investing for 50 years, so he knows a thing or two when it comes to investing. Ray Dalio started a company, Bridgewater Associates, from his small apartment in New York City. He ran this company for almost 47 years, and it became the biggest hedge fund in the world. It's also one of the top 5 most important private companies in the U.S., as reported by Fortune magazine. He came up with new and smart ways to invest money, like risk parity, alpha overlay, and all-weather. These ideas changed how big organizations all around the world invest their money. He's gotten many awards for his lifetime achievements in this field. Plus, for many years, important people who make decisions about money in different countries have asked him for advice. Let's look at what Ray Dalio has to say about the shift in the stock market and economy that's changing the investing landscape. We're in the 12th and a half cycle of a pattern that happens over time, like how seasons change. This has been happening since 1945, which was a time when the world changed a lot, especially in how money worked. Sometimes the economy gets weird and not so good, and this happened in 2020 because of COVID-19 and a shift in how money was shared. To deal with this, the government gave money to people, and the Federal Reserve lent money to the government. This made a lot of money in the system, like when you have more money to spend. This follows a common cycle. Things start well, but then borrowing turns into debt. Prices rise, which leads to inflation, and then the government tries to control things by making money less available. So where are we now? We're in a familiar situation where the real interest rates, which show how much money is worth, went from being less than nothing to being positive, from minus 175 basis points to plus 175 basis points. Also, the interest rates for regular cash are higher now, which makes cash more attractive. It's like how $1 in your pocket is worth more than before. Now we have an inverted yield, which means that things that were predictable before are now a bit mixed up. Before we dive deeper, make sure to hit that like button and subscribe to this channel for more incredible life-changing content. Now, let's move on. According to Dalio, something interesting is happening. Cash is becoming more appealing than before. This applies when comparing it to bonds, but it's also looking attractive compared to stocks. Here's how it works. When interest rates go up and it becomes harder to borrow money, parts of the economy and the market that relied too much on borrowing start to struggle. It's like air going out of a balloon. This change shows up in things like long-term stocks, like tech stocks going down, as well as investments like private companies and new startups going down. Imagine it as a repeating pattern, happening about 12 or 13 times since 1945. In this pattern, something else is also happening. Over time, a lot of debt and money gets piled up. It's like when you keep collecting things and they start to take up a lot of space. This whole situation is kind of like a story we've seen before, and we're halfway through it. The debt ceiling is quite significant. It's like a limit set on how much money the government can borrow. Think of it as a personal spending limit. When it comes to debt, the amount matters. If we have too much debt, it can cause problems for the economy, just like how having too much credit card debt can cause issues for a person. In the past, the market was influenced by simple supply and demand, like how many people want something compared to how much of it is available. But now the Federal Reserve is playing a role by buying things like government debt, which changes this balance. It's a classic situation that's been happening for a while. However, many people may not be paying enough attention to the larger pattern. There are shorter patterns too, which repeat roughly every 6 or 7 years since World War II. These shorter cycles have their ups and downs, but they're part of a bigger cycle that we're in the middle of. This larger cycle is influenced by factors like accumulating debt and issues with the value of money, especially in the context of the global economy. It's like a puzzle where all these pieces fit together, and it's crucial to understand how they affect each other. We're in the middle part of the cycle, which means there's still another half to come. Picture it like a roller coaster. We're halfway up, and we need to go all the way down to finish the ride. To manage this process, we need to hit the brakes to slow things down. This helps bring things down gradually, but it's not the same for every cycle. In each one, things might need to be adjusted differently. In this particular cycle, there were a lot of things getting too big, like bubbles growing. Now, as we're moving down, we can see which areas are affected. You can notice certain types of sectors going down, like technology and real estate, just like how the roller coaster slows down and you feel the drop. When residential real estate goes down, it might not necessarily mean families are struggling, because actually families are doing better with their money than before. They have a lot of money. And also, when prices of things go up, the amount of money people earn goes up too. So even though real estate is going down, the people in households are kind of benefiting from these changes. It's like a balancing act. So what's happening is a kind of shrinking. Things are going down, and it's like an economy that's not growing a lot, but also not shrinking too quickly. It's kind of stuck in the middle, and we might even see a situation called stagflation, where prices are going up, but the economy isn't growing much. That's when we have stagflation. Imagine it like an economy moving in slow motion. In this scenario, inflation might slow down a bit, and because of how it's measured, it could later look like it's going up again. So it's like a back and forth movement. During this time, the economy might grow at around a 1% rate, meaning it's not super fast, but it's not completely stopped either. At the moment, this market's perception, depending on what you believe the market is, doesn't think that inflation is going to stay high. This belief is influenced by a few factors, like the way interest rates are set and how people think about future values. You see, it's like this. There's something called a yield curve, which is like a graph showing how much interest you get for different lengths of time when you lend your money. This curve shape matters. If the curve slopes a certain way, it's not necessarily because everyone is super smart and planned it that way. It's more about how different markets trade and interact. For example, if the market for long-term loans and the market for longer-term loans have different prices, this curve happens. If you find this video informative, like and subscribe to this channel for more educational content. Thanks for watching. Let's continue. And it doesn't seem like the market has already factored in a decrease in inflation, at least not fully. If you check bond prices like the price of lending money, even if the bond rate is 3.4% or 3.5% and let's say inflation is around 2%, that still leaves you with just a 1.4% real interest rate. This means that the return on lending money isn't very high when you account for inflation. However, looking at the bond rates, they still seem pretty low. There were also big differences in the prices people were willing to pay for certain types of lending. A big shift is happening in how people invest their money. For the first time in nearly a generation, investors can generate a return from cash. There's a new opportunity. You can make money from the cash you have, which is pretty cool. This new way is cash alternatives. One way to do this is by getting short-term U.S. Treasury bonds. These are like special papers backed by the government that say they will give you back more money later. When you buy these bonds, you can make more money compared to just putting your money in a regular savings account or a high-yield savings account. So think about it this way. Instead of just keeping your money in a regular bank account, you can put it in these special bonds and watch it grow. It's a bit like planting a seed and knowing exactly how much it will grow into a tree. These bonds have a fixed rate, which means the amount of extra money you get is set from the beginning. It's a guaranteed return on your money. This is a big change and a good chance for people to make their money work better for them. Ray Dalio is saying that having both cash and bonds in your investment mix might not cause you to lose money when you consider inflation. In the past, Ray Dalio mentioned that having a lot of cash could be a problem because the value of that cash might decrease over time due to inflation. It's like your money losing its worth. However, the situation has changed. Now, according to Ray Dalio, you can hold on to cash and use it to invest in big chances that can make your money grow. This means that keeping cash isn't a bad idea anymore, especially when you can use it to jump on exciting opportunities that might come your way. It's like having the chance to make your money work for you instead of losing its value over time. You can leverage cash for big financial investments with good returns. Understanding the once-in-a-generation opportunity he presents is key to making informed financial decisions. A solid grasp of the changing investment landscape can greatly impact your financial future. Don't forget to like, share, and subscribe for more valuable insights and updates. Until next time, stay tuned.